I forgot to adjust my headset. So, as I was saying, we are live. And so let's get this stream started. Today, I want to talk about Tesla. And the truth is, and as an economist, I'm looking at the economy from a macro point of view. I typically do not discuss individual investments, although I do want to start a series when I get the chance, when I get some free time, about how to properly invest in stocks and bonds. It's not what you think, you know. A lot of the advice that's being dispensed out there is wrong-headed, and I don't want to make that sound arrogant, but it's actually true, right? And if you want the summation of my advice, the number one thing is do not try to time the market. But anyways, getting back to the point of the stream, I do want to talk about Tesla because it is such a popular stock. A lot of people are investing in it, and I think there's some risks that are inherent um, in the company that the public needs to consider. Now, I'm not a Tesla hater. In fact, I admire them a great deal. I think Elon Musk is a terrific individual, a genius, really, and I very much admire and respect what he has done with the company. They started with a very difficult financial climate. I believe that they have turned the corner. They are now very much a viable, profitable company. So I'm not um, calling into question any kind of thing about their basic business model. I think those kind of questions actually is settled. I see Tesla as a very viable, company. However, that is a separate question from whether their share price is actually appropriate, right? And so let's delve into that question right now because, as my title said, I didn't mean it to be clickbait, but I'm going to offer you some analysis that I think will be a little bit eye-opening. And I want to stress first of all, that uh, this is not my analysis, right? A lot of times, my channel is about debunking, headlines in the news. But I'm realizing a lot of times, bringing clarity to the public means highlighting analysis and commentary that I think is particularly insightful, something that people should pay attention to in order to make the right decision, right? So, with that said, let me get started. Um, uh, so, this article is that I want to discuss today is from Ross Hendricks, and it's titled "The Most Dangerous Stock Market Ever." Now, he's talking about the effect of options trading on the equity market, the New York Stock Exchange, and so on and so forth. And so he covers a broader territory than Tesla itself, but I want to focus on the part where he discusses Tesla, and I think this analysis is very apt, right? Something that's not really being discussed out in the public, and I want to make that available to you. So, again, I want to give full credit where it's due. And so this analysis really comes from him. But anyways, to press on, right? Um, let's take a look at the first chart because we're all about data. We're all about objective analysis of the economy, and in this case, the stock market. Uh, we're talking about the dangers of options trading, right? And if you look at this chart, I hope you can see this clearly. You see that the level of options trading remains quite steady within the range until we hit 2020. Starting in 2019, right, we have a major surge in options volumes uh, going all the way back to 2007, right? So this chart is saying that it's a mania. I don't want to use those kind of, emotionally charged words, but we definitely see an upward trend. And so what does that mean for Tesla, right? What does that mean for stock valuations in general? That's exactly what we're going to discuss today. So, um, along with the fact that we have a record surge in options trading, right? Uh, the data is showing that we also have um, a lot of speculators in the market who are maxed out their leverage. Record 912 billion in margin debt. Now, if you're not where what margin debt means. It's not a big deal. Just think of it a way to extend, uh, your bet, the impact of your bet. They're basically borrowing money to bet on the stock market, which, by its very nature, it's very, very dangerous, right? And again, so what does that have to do with Tesla, right? Well, let's start with this, right? In the old days, right, options trading volumes paled in comparison to stock market volumes, right? After all, options are a derivative product designed to provide a form of insurance for stock investors. So what that really means is, let's say you went long on a stock, right, particular company, for example, Tesla, but you want to protect yourself. You want to have some insurance, and so, uh, you might have some put options and saying, well, if the stock goes down, then I'm protected on the back end, right? So we're not going to talk deep into what options trading means, but um, yeah, basically it's an insurance against your main bet on a particular stock, right? And as we're saying, no one ever imagined they'd become a primary asset class, overshadowing the underlying instrument that they were designed to insure against. So, what does that really mean, right? If you're not familiar with options trading, imagine if there was you were trading cars, right, on the used market, right, and then you were also buying the insurance on those cars to make sure that they don't go bad, right? Because they're used cars and sometimes they break down, right? Now, imagine if the trading on the insurance uh, that is attached to used cars actually became a bigger market than the cars themselves, right? That's a little lopsided. That's like the tail wagging the dog, as they say. And it looks a little odd, doesn't it? Right? The underlying asset, which is the stock, which is the used car, um, collectively is a smaller market than the market for the trades for insurance. It's, on the face of it, it looks a little odd, and sometimes it is a sign of speculative froth, right? And that's what we're going to get into. Okay, so let's take a look at uh, this chart where remember I was talking about how you're trading used cars, but the insurance on used cars might actually be a bigger market, right? Well, starting in around 2019, 2020, right? Take a look at this chart, right? Remember, I was saying, well, there's more money in trading the insurance on the used cars than there's on the cars themselves, and that's exactly what you see, right? The underlying assets, what I would call the used cars, is this yellow line, and of course, there's more trading that's happening, right? It's going up and up. But look at the purple line for options trading, right? At this point, sometime in 2020, uh, the options trades actually exceeded the stock, right? Um, and that's sometimes a very dangerous situation, right? And in fact, it does have some meaning into why Tesla shares have, gone up so quickly. And a lot of it really has to do with the options trading and the speculative froth that we're seeing in the general equities market. And of course, Tesla is being traded. There's a lot of excitement about that stock, right? So, to press on, we'll have a brief talk about, Tesla. And this analysis is kind of harping on the regulatory emissions credits, which now don't really matter that much, right? Before, the criticism against Tesla was that regulatory emissions credit was their biggest source of income. That's not true anymore, right? They're making their primary income from the sale of the automobiles. So that's why I said I think Elon Musk has done a fantastic job. I do admire Tesla as a company. I think they've turned the corner, right? So they're making most of their money from actually selling their cars, right? Which is a very, very good thing. Mhm. And it looks like the self-drive software is also a source of income, and it's talking about how it's vulnerable to regulatory crackdown. I don't think that's really a huge factor. You could say that about anything. Any kind of business activity is vulnerable to regulatory crackdown, and all kinds of software development. So that I think is not a big statement. Although on the other hand, I have to say, like I said, I do admire Tesla, and I have high hopes, and I truly, truly wish them success. I want them to win. I want them to succeed in the full self-drive software because that's a dream of mine. Having a self-driving car would be wonderful. I could take a trip to my hometown Vegas and read a book along the way. But anyways, uh, the thing that really we need to discuss is the valuation of Tesla, right? And so typically for the automobile industry, right, you get a 8 to 12 times um, of their net income, right? When you talk about valuation methods, you typically take their net profit or EBITDA or some other measure of their income, and then you multiply by a standard, an industry standard multiple, right? And so typically for automobiles, it's 8 to 12 times is the industry standard. But we do need to say that Tesla is innovative. We do need to say that Tesla is not like Ford. It's not like GM. There's a lot of excitement about what they're doing. And I think a lot of people rightfully have faith that they deserve a higher valuation. But even if we assign a generous 25 times earnings multiple, right? That leads to a valuation of roughly $50 billion. Personally, I think that's very high. There's still also a lot of risk associated with Tesla, but let's just give them the benefit of the doubt and say, it's 25 times earnings multiple, and they're roughly worth $50 billion, right? Um, so that's their valuation sometime, I think, in late 2019. But after as that period, as we get into 2020, something really unusual happened, and it's related, like I said, to the options trading. Okay, so uh, starting in October 2019, something strange happened. Tesla call option volumes spiked into the stratosphere, surging from 1.5 million to over 6 million contracts. That's a fourfold increase from the prior month, and volumes only went higher from there. By January 2020, Tesla call volumes had ballooned tenfold to over 15 million contracts. And after a brief hit for the COVID meltdown, call volumes continued to grow as high as 36 million contracts by December 2020. Right. So, the big spike that we saw in options trading here, right? And this is for the entire stock market. We started to see that in early 2020 for Tesla itself, right? Um, so that's a 25 times increase in Tesla call volume, call options volume from September 2019 through the peak of December 2020. So let's just step back and pause here for a second and talk about what that really means. We're talking about a 25 times increase in call options activity, right? Basically, what that means is people are buying call options expecting that the price will increase, right? Call options again are a way to leverage your bet to make more money, but that entails more risk, obviously, right? And so this sudden spike, I mean, we're talking 25 times increase. This sudden spike does start to look like speculative froth, right? And let's dig a little bit deeper into that, okay? So the question is, in a period of just 18 months, okay? Look at this chart. Look at this chart. Um, did rational investors decide Tesla's fundamental business value increased from 50 billion to 1 trillion in only 18 months, right? Is that like it? What changed within that 18-month period? Remember, we're talking about September 2019 through December 2020. That's during the time when we were on COVID lockdown. Now we have supply chain problems, chip shortages. The entire automobile industry is suffering, right? Um, and yet somehow their valuation went from 50 billion, which already is rather generous, I think, to $1 trillion, a $1 trillion company, while a COVID lockdown was happening. What fundamental thing about their business model changed to justify that a double in their valuation, an additional $50 billion of worth to the company, right? We were on COVID lockdown. What changed in the supply chain? What changed in their sales, right? I don't know of anything, right? So this article is basically uh, saying that Tesla stock rose up because it was a massive, massive gamma squeeze, right? Now, if you haven't heard the term gamma squeeze, don't worry about it. We're gonna explain that very quickly. Okay, we're gonna explain what that means. But basically, right, um, the contention of the article, which I think is well worth discussion, um, is basically it says right here. Tesla's share price, along with the broader stock market, has inflated under the tailwind of a record option buying spree over the last 18 to 24 months. In the case of Tesla, it's instructive to note that the share price leveled off just after call options volumes peaked starting in January 2021, right? And so we're going to explain the gamma squeeze thing really quickly, but first, it makes a very vital point here. You know, if you look at the data, right, what it's saying is that once this massive increase in options trading, and you saw it here, this massive increase in options trading, right? Once it started to level off, so did the Tesla share price, right? Now, that's correlation. That's not causation. But when you think about this 18 to 24-month period where mostly we're on lockdown, you have to question, whether there was, any fundamental innovation or revolution development in the Tesla business model or the technology that would justify a doubling of the company valuation. Again, I don't know of any. And it's telling that when the call options volumes level off, the share price also started to level off. Okay. And so, according to this data, it certainly looks like the massive jump in Tesla share price is driven by the options call trading, right? Specifically, the gamma squeeze. So let's get into a discussion of what that means exactly. It's really not that complicated, okay? So let's get into that. So, what is a gamma squeeze, okay? A gamma squeeze is a trading terminology that refers to massive call buying leading to higher stock prices, which leads to more call buying, a higher and then that leads to higher stock price and so on. So I don't think that was really clear. This is the official definition of a gamma squeeze, but um, let's try to clarify more details about how that happens. What is the exact mechanism where options trading leads to a gamma squeeze, and we get this effect of the share price going up? Okay, so another way of saying that is when a speculator buys a call option to bet on higher stock prices, right? You saw in the chart that the call options trading volume on Tesla stock skyrocketed starting in September 2019, right? The market maker who sells the option becomes net short the underlying stock, right? That means the options dealer will often hedge their short position by purchasing the underlying stock. So, okay, let's untangle what this really means, okay? So let's say you have somebody, maybe myself. I said, you know what? I am sure, I am so sure that Tesla stock is going to go up. I'm going to leverage my bet. I'm going to buy a call option, right? Maybe even on a margin, right? And I'm going to buy that, and that's going to give me the right to buy Tesla stock sometime in the future where I'm certain that it's going to go higher, right? And so the person who was writing that call option, who was selling you that call option, kind of like the car insurance, that's being sold by an insurance company, they're getting a little nervous, right? They get a little nervous. Okay, what if it really does go up, right? And if I buy this stock later, then I'm going to take a hit, right? Right now, Tesla stock is at a certain level, but if this guy who's buying the call option is right, it's going to go up. And if I wait to buy the stock, right, then I'm going to get squeezed. So what do? They buy the underlying stock right there immediately, right? Well, not immediately, but you know what I mean. It's kind of like what I said about the used car and the insurance, right? Um, if if somebody buys a used car insurance and they're expected to deliver a used car sometime in the future, they might just buy that car now, right? To ensure that the price of it doesn't go up, right? And so what happens is you start to get into this kind of spiral, right? This cycle. So what happens is people are buying call options. The market makers, right, are buying the underlying stock. What happens when you buy underlying stock? It goes up. It goes up, 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 right? And so people are then saying, hey, wait a second. I bought call options saying that Tesla stock is going to go up, and then it did go up. So I'm going to buy more call options, right? I'm going to buy more because I was right. I'm a genius. I am an investment genius. I am so brilliant. I made the right choice. So then they're going to buy more call options, and then the market makers are saying, okay, you know what? I'm short here, right? I'm exposed. So then they buy more of the underlying Tesla stocks, which drives up the price even more, and so on and so forth and so forth. So that's cycle, right? Um, uh, could very well, it probably is. It probably did have a huge impact on the rise of Tesla shares because that's the way the options market work, right? When the volume of trades and option calls, call options goes up, right? Somebody is going to have to protect themselves, right? Now, I'm not saying the only reason why Tesla shares have gone up is because of the options trading. I think there are actually valid reasons to buy Tesla, you know, because like I said, I think they've really turned the corner, especially in the 2001, right? But do we uh, do we see this massive trading in call options as having an impact on share price? Of course it does. Of course it would, right? And this is not something that's being discussed widely in the media. Okay, so we've got this options trading driving up the price of Tesla shares. Now we've got another factor, which is social media, right? This individual, Jason DeBolt, is a very popular figure that's being followed in Tesla circles. And his tweets, for better or worse, whatever you think about investment by tweets, right, is driving um, possibly hundreds of millions of dollars in trades on Tesla, you know, and they're trading on the margin, essentially borrowing money to bet on Tesla stock. That's very dangerous, right? And this is all being driven by the options trading. Now, the question is, if this is true, how long can this go on, right? Well, let's take a look at some data. You know, I'm not one to offer ungrounded opinions. We need to take a look at data to answer this question. Okay, and so let's take a look at this chart, right? And this is talking about how much money the U.S. households have invested in the equity market, right? So, looking at the title, U.S. households have the largest exposure to the stock market um, ever, going back to 1951. 1951, and it even exceeded the peak period during the dot-com bubble. Now, if you were around for the dot-com bubble, you know that everybody and their neighbor and their pet dog was investing in internet stocks, right? Thinking that everything's going to go up and up and up, and of course, it all ended in tears, right? I even worked for an internet startup company, and unfortunately, it didn't go well, right? And so, take a look at this chart right here, right? Around 2001. That was probably the exposure for the dot-com bubble right here, and then there was a crash, And now we are at an even higher point of exposure to the stock market than during those risky times. Okay. So, what does that really mean? Okay. In conclusion, right? The article is contending that the massive increase in Tesla valuation from 50 billion, which is already generous, to $1 trillion company was primarily driven by options, call options trading, and even worse, it's really being driven by this fear cycle of a gamma squeeze, right? Where people are speculating and driving both, the call options and the underlying stock higher and higher. But there is a break point where people have already invested all they can into the stock market, right? And then people are going to realize, wait, this stock isn't moving anymore. And you saw that, right? Um, Here, let me see. Sorry. Um, oh boy, I should. Sorry about that. I should. Here we go. um, you saw that in this chart where it said, as soon as call options volumes leveled out, the share price leveled off, right? So, considering the fact that people, well, by people I mean speculators, have maxed out their leverage, right? They're buying, they're investing on the margin. Uh, the exposure of U.S. households is the highest it's ever been since 1951, right? We're starting to get the feeling that maybe everyone's already gone all in on the stock market and especially on Tesla. So where do you go from here? Well, if it can't go higher, where do you go? Typically, it's going to skate for a bit, um, but it's likely that Tesla valuations will readjust downward, right? Especially if it's a gamma squeeze, right? It really matters the reason why a stock goes up. If the fundamentals warrant that, absolutely, it deserves to have a higher valuation. If it's because of a gamma squeeze due to higher options trading, it's going to go down. It's a very, very dangerous time for investors. If you're looking at Tesla, I would really, advise you to consider this data before going all in, right? You should always diversify your investments. We all know that. But anyways, so that's it for today. I hope you found that useful. Like I said, there's a lot of excitement about Tesla, but you need to understand the risk involved before getting into a hot stock like this. So, anyways, that's it for now, and I'll see you in the next video.